All right, everyone get ready, because we are diving deep into market timing versus buy and hold.
Oh, yeah, this is a big one.
It is a big one. And I'm Kian,
I'm Nika.
and we are ready to go deep as always. So we know you're busy professionals,
Yes,
probably already knee-deep in market trends and financial reports and everything.
absolutely.
But today's deep dive is about taking that to the next level. We've got some fascinating research, some real-world examples, and maybe even some surprises along the way.
Ooh, I love surprises.
Yeah. So the million-dollar question, or maybe multi-million-dollar question, is this. Is it really better to try and time the market swooping in and out like some kind of financial ninja, or is it smarter to just buy and hold, riding the waves for the long haul?
Well, let's start by making sure we're all on the same page. Imagine market timing like trying to catch a falling knife.
Ooh,
Tempting.
yeah. Yeah.
Potentially rewarding, but definitely risky. You're constantly watching for that perfect entry and exit point, always trying to outsmart the market.
Okay, I get the feeling this is where I'd probably end up cutting myself.
Yeah.
But it sounds exciting, right? Being able to predict those big swings and capitalize on them.
It does. It does have that certain allure. But the reality is, even seasoned professionals with all the fancy algorithms and data at their fingertips struggle to consistently time the market.
Right.
It's really hard.
So let's talk about buy and hold.
Okay.
This feels more my speed.
Mm.
Less adrenaline, maybe a little less glamorous, but hopefully more stable.
Yeah, I think of it like planting a tree.
Oh, I like that.
You choose a healthy sapling, you nurture it, you give it time, and eventually it grows into something strong and resilient. Buy and hold is about selecting solid investments and letting them flourish over the long term, weathering any storms that come along.
Okay, I'm liking the tree analogy.
Right?
Much more peaceful than dodging falling knives.
Right.
But honestly, the whole time in the market beats timing the market thing.
Mm.
Is that more than just a catchy phrase? Does the data actually back that up?
It absolutely does. One of the most compelling pieces of evidence comes from a study by Nobel laureate William Sharpe. His research found that to consistently outperform the market through timing, an investor would need to be, right, get this, a staggering 74% of the time.
74%? Seriously?
Yeah.
I mean, I'm optimistic, but those are some pretty daunting odds.
It highlights just how difficult it is to predict those short-term market movements with any kind of consistent accuracy.
Yeah. So even if I think I've got a knack for spotting trends, the odds aren't really in my favor.
Not really, no. And here's another point to consider. Even missing just a handful of the best trading days over a long period can have a significant impact on your overall returns.
Hold on. Missing a few days can really make that much of a difference.
Think of it like trying to jump onto a speeding train.
Okay.
If you miss the window, you're left standing on the platform watching your potential profits race away. Research has shown that missing even a small number of the market's best days over a 20-year period can potentially cut your returns by more than half.
Wow. Okay, that's a pretty powerful visual.
Yeah.
So it's not just about avoiding losses. It's about being positioned to capture those big gains when they happen.
Precisely. And let's face it, nobody can consistently predict when those big wins will occur.
All right, so let's get real for a minute. Imagine someone decides to invest a large sum right before a major market crash, like, say, the 2008 financial crisis. Ouch, right? Compared to someone who just stayed invested and rode out the storm, the difference in their outcomes could be huge.
It's a stark reminder that trying to time the market can lead to some very costly mistakes, especially when fear and uncertainty are running high.
Okay, you've definitely made me think twice about trying to be a market timing guru.
Yeah.
But if we're talking about the S&P 500, hasn't it generally trended upwards over the long term? We've got decades of data to back that up, right?
Absolutely. Looking at the returns for the past 5, 10, 20, and even 30 years, the S&P 500 has consistently demonstrated an upward trajectory. And while past performance is never a guarantee of future results, it does offer some valuable perspective.
So let's translate this into real-world numbers. Say someone invested $10,000 in the S&P 500 back in 2004 and just held on to it. What kind of growth are we talking about here?
Well, based on the average annual returns for that period, which is about 9.8%, that $10,000 investment could have potentially grown to over $50,000 by 2024.
Wow.
That's the power of staying invested and letting compounding work its magic over time.
Okay, that's a pretty impressive return. Suddenly, buy and hold is looking a lot more appealing. But let's be honest, staying calm and collected during a market downturn, That's easier said than done.
You're absolutely right. The emotional side of investing is a huge factor. When your portfolio is taking a hit, it's hard not to get caught up in the fear and panic.
Exactly. My brain knows I should stay the course, but my gut is screaming, sell, sell, sell.
And that's precisely where a strategy called dollar cost averaging can be incredibly valuable. It's a way to help you navigate those emotional ups and downs and stay disciplined with your investments.
All right, dollar cost averaging, tell me more. How does it work and how can it help me tame my inner panic monster?
It's actually a very simple concept. Instead of investing a lump sum all at once, you invest a fixed amount at regular intervals, like monthly or quarterly, regardless of what the market is doing.
So even when the market is like taking a nosedive, I'm still investing the same amount. That feels a little counterintuitive, like I'm just throwing money into a fire.
I understand that feeling, but here's the key. When the market is down, your fixed amount buys you more shares at a lower price.
Okay.
Then, when the market inevitably recovers, those shares you bought at a discount become more valuable. You essentially benefit from the downturn by acquiring more assets at a lower cost.
Okay, I'm starting to see how that could take some of the emotion out of it.
Exactly.
It's less about trying to perfectly time those peaks and valleys and more about consistently building my position over time.
Exactly. Dollar cost averaging helps you tune out the market noise and focus on the long game. And speaking of long-term strategies, we've talked a lot about the S&P 500, but I'm curious, are there any other types of investments where buy and hold really shines?
That's a great question. I'm thinking about my own portfolio now. Are there specific sectors or asset classes that lend themselves particularly well to a buy and hold approach?
Well, while many people associate buy and hold with the stock market and the S&P 500 is certainly a popular choice, it's not the only option. You can apply this philosophy to other asset classes as well.
Like what? Give me some examples.
Real estate is a classic example. Historically, real estate has tended to appreciate in value over time. Plus, it can generate passive income through rental payments. Of course, real estate investing has its own complexities, but it can be a great fit for a buy and hold strategy.
Interesting. So I could buy a rental property and essentially hold on to it for years, letting it appreciate in value while also generating income. What about bonds? I know those are generally considered less volatile than stocks.
That's right. Bonds are often seen as a more conservative investment, and they can play a valuable role in a diversified buy and hold portfolio. They typically offer more stability than stocks, although their potential for growth may be lower.
So it sounds like buy and hold isn't just about picking a single stock and hoping for the best. It's about building a diversified portfolio across different asset classes.
Absolutely. Diversification is crucial for managing risk and building a resilient portfolio. By spreading your investments across different asset classes, industries, and geographic regions, you reduce the impact of any single investment performing poorly.
Right, like the old saying goes, don't put all your eggs in one basket.
Yeah.
But I'm still a little wary of just completely ignoring what's happening in the market. Is there ever a time to sell within a buy and hold approach? Or do I just ride it out no matter what?
It's not about blindly holding on to every investment forever. There are legitimate reasons to consider selling even within a buy and hold framework.
Okay, like what?
For example, if a company you've invested in experiences a significant change in its fundamentals, maybe a new CEO with a questionable track record, or a major shift in their industry that threatens their long-term viability, that could be a signal to reevaluate your position.
So I'm still paying attention to the fundamentals and performance of the companies I invest in. It's not just a set it and forget it approach.
Exactly. Buy and hold is about taking a long-term perspective, but it doesn't mean you're completely passive. You're still monitoring your investments and making adjustments when necessary.
That makes sense. It's about finding that balance between staying the course and being adaptable when the situation calls for it. You know, I'm still a little skeptical about completely ignoring market dips. Doesn't that mean I'm buying even when things look really bad? How do I know I'm not just throwing money away?
It's understandable to feel that way, but remember, market dips are a natural part of the economic cycle. They're often driven by short-term events or emotional reactions, and they don't always reflect the underlying value of a company or asset.
So instead of seeing a dip as a disaster, it's an opportunity to buy more shares at a discount.
Precisely. As long as you believe in the long-term prospects of your investments, those dips can actually work in your favor. Think about it. When you go shopping, do you get excited when prices go up or when they go down?
Definitely when they go down. I love a good sale.
Exactly. A market dip is essentially a sale on your favorite investments. It's a chance to accumulate more shares at a lower cost, which can amplify your returns when the market rebounds.
Okay, I'm liking this perspective shift. So if the key to successful buy and hold is finding quality investments with strong long-term potential. How do I even begin to identify those?
That's where research and due diligence come in. You need to understand the fundamentals of the companies or assets you're investing in. Look at their financial statements, their management team, their competitive landscape, and their growth prospects.
So I need to do my homework. But isn't that a lot of work?
Yeah.
Especially for someone with a full-time job and, a life outside of investing.
It can feel overwhelming, especially when you're first starting out, but there are resources available to help you make informed decisions without spending hours poring over spreadsheets.
Like what? Give me some tips.
Well, there are reputable financial websites and publications that provide in-depth analysis and ratings of different companies and investment vehicles. There are also financial advisors who can provide personalized guidance based on your individual goals and risk tolerance.
Okay, so I don't have to go it alone. I can leverage the expertise of others to help me navigate this complex world.
Exactly. And remember, investing is a journey, not a sprint. Take the time to educate yourself, seek out resources, and build a strategy that aligns with your long-term vision.
This is all starting to make a lot more sense. Now I'm feeling more confident about my ability to make smart investment decisions. But let's be real, investing can be stressful. Even with a buy and hold approach, there are going to be ups and downs. How do I manage that emotional roller coaster and stay committed to my long-term goals?
That's a great question, and it's something every investor struggles with at some point. Remember that market fluctuations are normal. They're a part of the process.
So don't freak out when my portfolio takes a temporary dip. Easier said than done.
I know it's tough, but try to focus on the bigger picture. Remind yourself why you're investing in the first place. What are your long-term goals? Are you saving for retirement, a down payment on a house, your kids' education?
Those are definitely things worth staying focused on, even when the market is throwing a tantrum.
Exactly. Visualizing those goals can help you stay grounded and ride out the inevitable storms.
And remember that tree analogy. Sometimes you need to weather a few storms for that tree to grow strong and tall.
Precisely. And just like you wouldn't uproot a tree every time there's a bit of wind or rain, you shouldn't abandon your investment strategy every time the market fluctuates.
This has been incredibly insightful, Nika. I feel like I've gained a whole new perspective on the buy and hold approach. But we've thrown a lot of information at our listeners today. Let's take a moment to recap the key takeaways for our listeners. What really stood out?
Absolutely. Where should we start? What do you think?
I think the biggest takeaway for me is that trying to time the market is a fool's errand. Even the experts struggle to get it right consistently, and the odds are definitely not in our favor.
Yeah, I agree with you there. Trying to predict those short-term market swings, it's so difficult, and potential downsides are significant. Even missing a few key trading days, like we said, can make a huge difference in your overall returns.
Right, it's like trying to catch lightning in a bottle.
Yeah.
Much better to focus on strategies that have a proven track record,
Yeah.
like buy and hold.
Exactly. And combining buy and hold with dollar cost averaging can be such a powerful way to build wealth over time while minimizing stress and avoiding those costly emotional decisions.
Dollar cost averaging, yeah. That's been a game changer for me. Knowing I'm investing consistently, regardless of what the market is doing, it gives me a sense of control and helps me stay disciplined.
And it's great because when the market dips, you're actually buying more shares at a lower price. It's like getting a discount on your favorite investments,
Yeah.
A sale. Who doesn't love a sale?
I love a sale.
Exactly.
It's funny how a simple shift in perspective can make such a big difference. Instead of fearing those dips, I'm starting to see them as opportunities.
Yeah. That's the power of understanding how the market works and having a solid strategy in place. And let's not forget about the magic of compounding. By reinvesting your earnings over time, you're essentially putting your money to work for you, generating even more returns.
Compounding. It's like watching a snowball roll downhill, gathering more and more snow as it goes. The longer you let it roll, the bigger it gets.
Love that analogy. Perfect analogy. But while this deep dive has given you a lot of valuable information about market timing versus buy and hold, it's important to remember that the best investment strategy for you will always depend on your individual circumstances.
So what's the one thing you want our listeners to walk away with today? What's the most important piece of advice you can offer?
I would say this. Think about your own risk tolerance, your financial goals, and your time horizon. This knowledge empowers you to make informed choices that align with your unique situation. Are you saving for retirement decades down the road? Are you looking to buy a house in the next few years? Your investment strategy should reflect your individual needs and priorities.
That's such an important point. There's no one-size-fits-all approach to investing.
Okay.
What works for one person may not work for another.
Right, exactly. And remember, smart investing is a journey, not a sprint. Take the time to educate yourself, seek out resources, and build a strategy that you're comfortable with.
Couldn't agree more. This deep dive has given our listeners the tools to navigate that journey successfully. Thanks for joining us, everyone.